Hong Kong's IPO market is roaring back after being in the doldrums the past 2 years. With investor demand surging and blockbuster deals like CATL, the Asian financial hub is moving closer towards reclaiming its global IPO crown. The companies have raised so far $13 billion this year, and consultants Deloitte reckons that total fundraising will hit $25.5 billion by year end. Now, earlier, I caught up with Hong Kong Exchanges and Clearing's CEO, Bonnie Chan, who's shared what's driving the pipeline and how she's positioning the exchange for pole position.
This year, we are seeing, I would say, a few clusters of listing applicant. Quite a big portion are these companies which have already listed in the mainland Chinese market, the A-share companies coming to Hong Kong for a second listing, a dual primary listings. And there are about, by now, close to 60 of them waiting in the pipeline. I think a big reason for them pursuing this A then H IPO is the fact that many of them have international ambitions. And so for them, having an offshore fundraising platform is particularly convenient. Also, many of them, given their international footprint, they will have employees all around the world, and therefore having Hong Kong listed stock as a form of remuneration, for their employees is also very attractive. And adding to that, the convenience of having Hong Kong listed stock as potentially an acquisition currency. So that is quite a vibrant pool of listing applicants. I would also say that there is now a return of interest quite strongly from investors around the world wanting to look at opportunities, especially in the mainland China and the rest of Asia, and I think we're benefiting from that.
CATL, the $4.6 billion IPO listing, brought back attention to the top-tier Chinese industries in terms of listing in Hong Kong. How is HKEX capitalizing on the surge of interest from A-share listings seeking a H-share listing?
So actually, CATL, they exercised the green shoe, so it's $5.3 billion in total in terms of offering size. I think that's a very good example of what I mentioned earlier, A-share listed companies coming to Hong Kong for a second listing in the form of an H-share dual primary. Now, the reason is quite obvious. CATL has international footprint, and in fact, a very big portion of the money they raised through the Hong Kong listing will go to fund the building of a factory in Hungary. So I think this is very illustrative of the recent trend of this, going out phenomena of a lot of these companies. CATL actually, a few investors I spoke to mentioned two moments this year, the DeepSeek moment and then the CATL moment. And by that, they mean that, CATL really is a very strong catalyst, which brought back a lot of investor attention to Chinese assets. I think a very well-recited fact is also the fact that CATL's H share price, so the Hong Kong listed share price, is now trading at a premium to the A share price. Now, to me, that's symbolically quite important. It means that certainly they're benefiting from very strong interest from international investors.
There is still a 30-40% valuation gap between A shares and H shares, mainland Chinese companies listed in Hong Kong. Is this primarily a perception issue, do you think, or are there structural changes that HKEX can actually enact to close this gap?
So first of all, the gap is in fact closing, narrowing quite a bit recently. And if you ask me, the main reason why there is a discrepancy in terms of price, I think can be explained because those two pools of shares are actually not fungible. So basically, the price is set by a different price discovery mechanism altogether. I guess, we're very encouraged by the fact that we're seeing the H share price in general elevating in recent months.
More Chinese companies are walking away from U.S. listings because of administrative burdens and perceived political risks. How is Hong Kong positioning itself so that it is a credible long-term partner as opposed to being a listing alternative?
Well, I always say that Hong Kong listing can be very, very complementary, regardless of whether your first listing, it's in the mainland like the Asia companies, or in the US or elsewhere. One unique feature of the Hong Kong market is that we have an infrastructure called the Connect franchise, right? The Stock Connect program, which started in 2014, first beginning as a Connect program between Hong Kong and Shanghai, and then in 2016 extended to Hong Kong and Shenzhen. Now, the reason why this is very, very important is because of this mechanism, essentially any company, including international companies, listing in Hong Kong also benefit from southbound trading. And that is something which no other exchange can offer.
We've also seen overnight interest rates in Hong Kong fall significantly to almost near zero in recent weeks. This is despite the Hong Kong dollar peg to the US dollar. Is this unusual monetary dislocation, is that a symptom of a deeper fragility in the market system, or is this just, surge in investor risk appetite?
Well, there are a lot of reasons, I think, to explain that phenomena. But suffice to say, we can also say that's because the demand for Hong Kong dollar is high. And I was often told that I'm part of the reason because of that very vibrant Hong Kong IPO market. I would say in any event, the market has a way to adjust and find the new equilibrium. And I think, given that with the Hong Kong dollar is pegged to the US dollars, there's a way that the Hong Kong Monetary Authority can come in to make the necessary adjustments.